This is a comprehensive stock due diligence report on NextEra Energy Inc.'s NEE, covering multiple facets of the business, its financials, and its market position. 2. Financial health, latest TTM, Q3 2025 data. NextEra Energy runs a high-growth, capital-intensive model, which results in significant debt but strong operating cash flow. Metric value, latest TTM, Q3 2025. Analysis, context revenue, TTM, $26.30 billion strong and growing, supported by both regulated utility rate increases, FPL, and massive capital investments in NEE's backlog. Net income, TTM, $6.50 billion healthy profit generation, enabling the dividend growth policy. Profit margin, TTM 24.73%, very strong for a utility, reflecting efficient operations and the higher margin contracted renewables business. Total debt $93.12 billion high, but typical for capital-intensive utilities. The company's debt is largely non-recourse project finance or supported by regulated stable FPL cash flows. Debt to equity 144.2% high. 1:0 is common for utilities. The ratio has increased in recent years, which presents a risk, especially in a high interest rate environment. Interest coverage 2.34x. EBIT, interest expense, low, indicating interest payments are not extremely well covered by operating profits, which is a concern given the high debt load. Free cash flow, TTM, $11.98 billion highly negative, due to massive ongoing capital expenditures, 2395B, TTM CapEx, required to build renewable projects. The NEE segment focuses on growth investments over FCF generation. Current ratio 0.55 low, typical for utilities with stable, predictable revenues, indicating short-term assets do not cover short-term liabilities. 3. Valuation metrics. As of late 2025, NextEra Energy trades at a premium to the traditional utility sector, reflecting its high-growth NEE segment. Metric NEE value utility sector, average analysis P/E ratio, TTM, 26.00x approx. 21.3 quam, significantly higher than the industry average, implying the market prices NE as a growth stock, not a typical utility. Forward P/E 21.92xN, a discount to TTM P/E, suggests analysts expect earnings growth to continue. 8. Corporate governance and ESG, sustainability category, detail corporate governance, generally considered strong. The company has a history of high rankings in corporate excellence, e.g. Fortune's World's Most Admired Companies, number 1 in sector 17 times in 19 years. ESG score high, best in class, S&P evaluation score of 86 among its peers. This reflects its commitment to the clean energy transition. Environmental impact real zero. Goal, NE targets zero scope, 1 and 2 emissions without offsets. 52% of its current generation is carbon-free, one of the highest in the industry. Controversies. Past instances of lobbying against rooftop solar net metering in Florida to protect FPL's regulated business model have led to criticism. 9. Macroeconomic, international, and cyclical factors. Factor detail. Macroeconomic impact low, cyclicality, defensive. The FPL segment provides stable defensive earnings regardless of the economic cycle. However, the NEE segment's growth is sensitive to interest rates, financing costs, and inflation, CapEx costs. International exposure minimal to low. Revenue and operations are primarily focused on the United States and Canada. Currency risk is therefore minimal. The primary exposure is to North American energy policy and regulatory environments. Innovation and moat strong. Competitive moat. The moat lies in the dual business model, the massive scale of NEE's contracted backlog, vertical integration, and superior in-house engineering and technology expertise, e.g., advanced site selection, operational optimization, giving it a cost advantage in renewables development. Tax and accounting heavy reliance on tax incentives. Profitability is significantly boosted by federal incentives, most notably the IRA's tax credits and transferability provisions. The complexity of tax equity financing is a key component of its business model. Effective tax rate can be highly variable due to these credits.